For more on this and the state of the economy, joining us now, we've got Austan Goolsbee, who is the University of Chicago economics professor and former Council of Economic Advisors chair. Austan, great to have you here with us this morning. You know, as we're kind of parsing through exactly the market's reaction to more broadly the dollar and the strengthening of the dollar, we'd seen Mike Wilson of Morgan Stanley actually call this situation untenable. Want to get your reaction to kind of exactly what we're seeing in the currency equation and how that has a more broad economic implication too.
Well, it's critically important. I think it's worth noting that if you're old enough, you remember the whole battles of the currency wars with China and people we felt were devaluing against the dollar. This is as big or bigger than that. So I think the feeling that people got, the positive feeling that we're seeing a lot of factory jobs move back to the United States post-COVID, that is going to wear away if the dollar keeps appreciating like this, because American stuff is just going to be too expensive. You know, and manufacturing is the major export category. So as the exports get expensive like this, you'll likely see some pretty serious disruptions in various sectors in the U.S.
I mean, and not just in the U.S., right? I mean, when you talk about currency wars, it feels like in the U.K. you've got a currency war going on between the government and the central bank, for that matter, over there. I do want to dig more into the factory stuff, though, because can you sort of connect the dots for us, what you think? Because it doesn't seem like the dollar is going to, even though it's down a little bit today, it doesn't seem like that its run is over. So what kind of longer-term implications could this have in terms of the manufacturing recovery that we had been seeing in the U.S.?
Well, look, if this continues, it's going to stifle that recovery. And you're going to get the double blows, of course, that if the Fed is raising interest rates like this, A, it's going to increase the dollar's value worldwide relative to other countries. But B, that could easily start a recession in the U.S. And if you start a recession in the U.S., then forget about the international part. You're already going to have substantial drops in demand for housing, which, as you just pointed out, has already begun. But consumer durable goods, autos, a bunch of the categories which are normally quite interest rate sensitive, they're already going to be hit with the direct effect. And then if you add on top of it this dollar effect that's going to make the international export decisions even tougher, I think it could be a bumpy patch.
Austan, this bear market in all sorts of equity indices, of course, most importantly, I would say in the U.S., how damaging will that be to household net wealth? And then secondarily, how damaging will it be to the U.S. economy?
Household net wealth is easier to add up. You can add up, well, how many $1 trillion is it if equities go down by a various value? The impact of that on the U.S. economy, personally, I've been a little skeptical on the way up that a wealth effect is as big as some people say. I don't think that most people increase their consumer spending by that much just because their house value went up or just because their stock market wealth might have increased. So as it comes down, I don't know that it will have that much direct effect on consumer spending.
For consumers right now, though, they're also trying to navigate from purchasing everything from an iPhone to navigating some of the higher grocery costs, higher cyclical week in, week out costs. And so it seems like there's a much more kind of longer protracted ramification that even if we are ahead of the depths of what could be spelled out as a recession, that if you saw that happening for such a longer or protracted period of time, that there's a longer term implication. What might that be from your perspective?
Well, I think the answer to that, what the long term impact is going to be, depends heavily on whether you think this inflation has been coming from excess demand and stimulus, or is predominantly coming from supply shocks to the supply chain and energy prices and stuff like that. If you think that it's from demand, then the conventional Fed raises interest rates to suppress demand will work. That will get rid of inflation. We will experience a tough increase in unemployment. We might have a recession, but basically everything's got a clarity of purpose to it. That's conventional monetary policy. If you think that the supply shocks are playing a big role here, then the fact that we're seeing the shutdown of the Nord Stream pipeline from potential sabotage, plus the other international supply interferences, the Fed can raise the unemployment rate. The Fed can suppress demand, but too much demand in that world is not what's causing the inflation. So in that scenario, the long-term implication is stagflation, where we maintain the inflation rate and we add on top of it a slowdown of the economy. So that's why the Fed is in a tough spot here, they both have to navigate the balancing act, but also try to figure out what's the nature of the entire enterprise.
Well, and you could argue it's not just monetary that's in a tough spot. It's also fiscal that's in a tough spot here, because then they have to deal with whatever it is that is being wrought by the Fed's policy. And I bring that up because there is a report this morning that Janet Yellen may step down as Treasury Secretary after the midterms. Brian Deese, who's the chair of the Council of Economic Advisors, might also follow suit perhaps early next year. What's the next phase for the administration? I mean, does it make sense for them to leave and sort of to turn the page here, and then what's next?
I mean, it wouldn't be a surprise if after 2 years you start to see some turnover in the cabinet. That's a normal thing. You know, as they say, for the advisors to the president, it's a sprint, and for the president themselves, it's a marathon. So they've had a remarkably low amount of turnover in the first 2 years. So that part is natural. I guess the only thing that I would say about fiscal responses to monetary policy, it probably won't be. You know, if you look at the historic pattern of legislative activity, the president does in about 1 year almost everything they're going to do legislatively on the fiscal side. And then as you go through the administration, they rely more on executive orders and regulatory actions and things like that, but at a much smaller scale than what they do in the first 100 days or the first 1 year when they're kind of enacting their mandate. So you might not see as much on that side, certainly as you've seen for the first year and a half.
Mm-hmm. Austan Goolsbee, former chairman of the Council of Economic Advisors. Always great to get some time with you. Appreciate it.
Thanks for having me back.